get to new data on job openings out just moments ago. Rick Santelli's in the house, and he has that for us. Rick?
Yes, absolutely. A surprise. Strong number for job openings and labor turnover, affectionately known as JOLTS. Number 9,610,000. That best estimates, and it is the best level going back to May when it was slightly higher at 9,616,000. A revision also putting a little extra horsepower. Last month's 8,827,000 now stands at 8,920,000. And of course, rates moving up towards the high zone. Remember, the roller coaster ride can be wild, but I always like when it stops. It's the close that matters most to technicians. And if any close above 470, many that have been trying to pick a temporary top will, of course, concede, and you might see some late session selling, pushing yields even more aggressively to the upside. David, Sarah, back to you.
Okay. Now, this is the first jolt for the market this morning, and pun intended, frankly, because it's the JOLTS report. And I want you to see what's going on here. 9.6 million jobs. And not only that, they revised last month from 8.0 to 8.9. Again, I'm rounding. I don't want to go crazy on these numbers because honestly, it's not all that important. It's the trends that are far more important than what the actual numbers are. Now, we did roughly 5.9 million new jobs, hiring, however you want to look at it on this report. So we're still not quite, but very close to 2 times the jobs, a little bit under. So the question they're going to say is that it's going to make the Fed's job even harder because the economy is going too well, which is really the dichotomy I want to focus on here. Because you're going to hear the idiots out there talk about the fact that, well, the recession's coming, which again, if we ever do get the recession, it's going to be the most forecast recession ever. And it's not going to be close, which I guess if they say it long enough, we're going to actually get a recession because at some point we have to get one, I guess. And we've always gotten one at some point, regardless of whether they say we have one or didn't have one, which again, I don't know why we actually need to put labels on everything. But what I want to talk about here is that what happened with this is interest rates went up. This is why stocks went down, because now we have 16-year highs in the interest rates. Now, I'm also hearing people trying to correlate what happened in the 07-08 debacle to what's going on today. Now, if you want to just look at it from a statistical standpoint and go with the numbers, that's fine. But we wouldn't want reality to get in the way because clearly that's how our world works now. We don't look at reality or what the way facts are. What happened back in 07 and 08 when we had that big drop in the Great Recession, it wasn't about a normal market cycle. It wasn't about COVID. It wasn't about all the things we're dealing with here. It was a completely different world where we truly had a systemic problem in the banking industry. We almost lost all of the entire financial markets. So if you want to remove that picture out and ignore that fact, then okay, I'll listen to your numbers. But I prefer to deal with reality. And the way to deal with reality is deal with what has actually happened and what the possibilities of going forward are. Now, when I talk about people wanting to get in and get out in July, all you heard was things are too high, things are too high, things are too high, things are too high. Okay. And then you also had people that were saying, oh, it's going to go up forever. We're going to come back. We're going to come back. I can't believe it's up. Okay. And a year ago, when the market was down, all you could hear is everybody, you got to get out. You got to get out. And again, the market's down. It is a simple philosophy. And just listen to Warren Buffett. If you really must look at it, just listen to what he says. You buy low, you sell high. And again, I'm not saying you're always going to buy at the bottom because you're not, and you're not going to sell at the top either. But if you're selling when everybody else is selling, unless you're really good at getting back in at a lower point, and that's your plan is to sell now and realize that you may have to buy back in another month, and you're good at it, and you want to do the trading part rather than the investing, be my guest and give it a shot. Because I'm all for giving that a try. Now, so this is the first thing to hit this morning. Question is, what else hit us this morning? Now, want to listen to this.
Get to you, Jim Lebenthal, but the fact that you've got the market under pressure, you've got this relentless, as I said, rise in rates, and it's putting big time pressure on stocks. And yet you've raised your year-end target today on the S&P 500 to 4450.
Yeah.
So Meld those two together.
I will do that. By the way, great discussion yesterday. I know we're on today, but great discussion yesterday. Brian Belsky, Steve Weiss, Joe Terranova on which is right. What do REITs actually mean and where the market's going? So obviously I'm with Brian on this. I think that what rates are actually saying right now, Scott, is that economic growth is a lot better than people expected.
Okay. So I'm not the only one saying this. And clearly he's on TV show, so he can't be an idiot either. Being facetious, clearly, but no, Jim has some really good points. And again, not that he's always right, not that I'm always right, but I want you to listen to what he's saying. If the economy were going down and it were a problem, you would be seeing interest rates going down with it, because the expectation, and the markets are almost always correct on this. I can't even remember a time when they weren't, but the economy is too strong for what's happening. Now, does it mean that interest rates should always go up when the economy's strong? No. But they would be sliding massively if we were heading into a recession, and we just aren't. Now, that doesn't mean that there isn't a recession on the horizon, or that 2, 3, 4, 5, 10 years from now, we won't run into one. Don't read that into this. What I'm saying is this is a one-day event, and we've had since July, and I'm just going to say July 31st. It's not the exact date, but that's kind of the number I'm keeping in my brain. I believe July 18th was the most recent peak. But I want you to focus on that time frame. July 18th to the July 31st is kind of the most recent peak, and what that really means. We're having a pullback, folks. We're down a little over 9%, right around the 10% range on the NASDAQ since that time. Okay? Now, there's a lot of things that could happen with that. Now, we've talked September is usually the worst month of the year. Okay? Why? Well, let's take a look at that for a minute. Part of the reason why is that if you have a good year, up until September is the end of a quarter, and portfolio managers have to rebalance their portfolios. So if you've got stocks that are up money, you can sell them. If you've got stocks that are down money, you can sell them. So what you end up having is a lot of pressure being sold on portfolios for a lot of different reasons other than just the stocks themselves. It could be profit taking. It could be taking out tax loss harvesting. A whole lot of reasons in there that a lot of people aren't aware of and they don't talk about on the news all the time. So I don't look at September as being just a situation, specifically this September, that people were selling off of stuff that's a bad deal. Again, it's Apple. It's down significantly. Microsoft, they're down. These companies aren't going bankrupt anytime soon. And that's not the point. The point is somebody took some sell off, and they took some profit off the table. Personally, I think it's an opportunity for buying. Now, again, does that mean it's going to go up tomorrow? No. Does it mean it's going to go up for the next month? No. Not my point. I'm just saying that it's a better time to buy at a good solid company than it was at the end of July, for instance. That doesn't mean that buying at July was a bad deal, because again, you buy for the long term, you invest for the long term, you day trade differently. Now, Jim and I are on the same boat on this, and we think it's going to go down the road. It's going to be a good one. Now, here's why. Now, historically speaking, and you can kind of look at this if you want, break this down. You can see the website on here. Go take a look at it. I'm not, just picking numbers out of the air. But what it's saying is that 95% of the results were positive when the market was up over 10% by July. Now, in fact, it actually increased 4.8% from the July's number. Now, I don't know that I agree that it's going to go up 4.8% on top of the July number. I just personally think it'll at least get back to the July number by the end of the year, which I don't think is a big number. And again, I know the market's down 9% in 90 days or less than 90 days, which means it can go back 9% in 90 days. So the bigger issue is, why do I think this is happening? Because you're going to hear these people talking about the fact that the PE is too high and this is too high and all these negativity stuff. But when you break it down, all that's happening right now is interest rates. All we need are a few different points to go the other direction, which are going to happen, because if it doesn't happen, then the recession everybody's talking about can't possibly happen. But the other part I wanted to look at here, and everybody that sits back and says everything is just too high. Now, this was pulled earlier today, so the time stamp on this may not be exact, but year to date. Now, this is the equal weight S&P 500. It's literally down. What that means is that, and everybody keeps talking about the top 7 stocks, and they're not wrong. The top 7 stocks have made the market. But what that tells me is not that there's a problem. Now, I mean, there might be a problem with those 7 maybe not doing the growth that we want them to do over the next, year. But what it's telling me is that the market itself is not overbought and it's not too pricey. Because here's the bigger kick. I'm going to go back to my Excel spreadsheets that my son gets on me about all the time. And again, these are not specific, it may not be the exact numbers from the end of the day. These were numbers I pulled out a little earlier. But this is what I'm looking at, are the trends that I keep an eye on. So the NASDAQ is still down 18.82% from its peak in November of 21, when Powell said he was starting to lower rates. It's down 18%. It's almost still in a bear market. Seriously. The S&P 500 is down almost 12%, might even be 12. The Dow's down 10. Has anyone heard on the news today that the Dow, the S&P, and the NASDAQ are all, and the Russell, are all still in correction territory now and have gone back into correction territory? And that the NASDAQ is almost in bear market and the Russell is in bear market? I mean, seriously, no one's talking about this. Now, they're up from the bottoms, but this is the one I want you to focus on. From the bottom, the Russell's only up 5%. Again, what it means is that the 7 stocks that have done very well might be over, and I'm saying might be overvalued, but the rest of the market isn't. I mean, we're talking about, and this is the straight up numbers. This isn't equal weight. I didn't have time to go look at the equal weight, but you really want to take a look at it. Take a look at those numbers. But here's the bigger point. The non-equal weight Dow is actually, you can't see me, I guess. The Dow equal weight is actually down for the year. Or not equal weight, the straight up Dow is actually down for the year. Okay, so am I missing something here? Has the market just gone completely berserk and gone so high that we can't buy into it right now? What I look at is interest rates are at all-time 16-year highs, massively highs. Okay, the market isn't screaming. It's not running through the roof. Again, the Dow's actually down. The equal weight S&P is down. What it means to me is there's a lot of room here. Again, I'm not saying to buy in today, tomorrow, whatever, not my point. But we're definitely not in a position where I'm concerned about the market. Now, does it mean it can't go down? Sure, it can. I mean, it was down 38% a year ago, and we're down 18. So it could go down another 20% on the NASDAQ. You know, the S&P was down 26. It could go down another 15%. Sure. I mean, any of that stuff can possibly happen, but it's not like we're at all-time highs here. And when I start looking at things from a progressive standpoint, the numbers are just going to get better. And I want to go back to him because he starts talking about some things that I think are really important.
And that matters for top line revenues at companies. Combine that top line revenues with margins that should be bouncing back as inflation comes down, and you're going to see earnings growing again. That's the central thesis of raising the target.
Okay, so you hear a lot of these guys talk about the fact that, you know, we can't hold the PE ratios, we can't do this, we can't do that because, okay, but what he's trying to explain is very simply, with inflation going down and continuing to come down, core that is. Now, oil can throw a monkey wrench into this, don't get me wrong, but the core is continuing to go down, which means the margins on corporations should continue to be in line and get better. So as their sales continue to grow, because clearly, if we've got the jobs and we've got the people spending, which doesn't seem to be an issue, all it really need to make the PE ratios make sense is to have the earnings part of it. So if earnings are continuing to go up, we should be in much better shape. We're also heading into our 3rd month of declines. So if we have 3 months of declines, again, how often does that happen? And when is that going to turn? And it will turn. We just don't know if it's today or tomorrow, whatever else there is. Now, I want to stop it here. This is the one I want you to get into your heads, because a lot of people say, hey, take your money, put it into mutual or bond funds, bonds. And I had a lot of people ask me why I wasn't doing this earlier this year on a short-term basis. Now, again, I want to keep this in mind. I'm not suggesting that this is a long-term fix or that there's a long-term look at this. What I'm talking about is on a short-term basis. Everybody thought that the yields had peaked a year ago and that there was a nice little bit of recovery in the bonds and the bond mutual fund market first part of the year, but not a big one, and a time to buy in. Now, my issue with that was simply I wasn't sure that the cycle was over for raising. So I put a significant amount of my clients' portfolios into some CDs. I locked in once we got over 5%, got a bunch in at the 5.25%. But there are mutual fund money markets out there paying a really good rate. And those are going to follow the interest rates. So I used that for a short-term fix for my clients kind of in July when we got a little bit of a peak there and took some profit off the table, which was again a little early, but that's okay. Earlier than my normal, the September, like I was talking about, but I took some profits off the table, put the money into money market, making, a little over 5%. But it's been able to ride that wave. Now, you're going to hear somebody talk about the fact here in a minute that if you can ride the wave and get back in at the right time, it's a good way to do it. And again, this is what I'm doing with my clients currently. But it's not as complicated as they think it is. So I want you to listen to this video because we're talking about some bond stuff that I concerns me when I talk to clients who haven't been clients of mine before, potential clients, on what's the difference the way I manage portfolios and what they've seen in the past.
Appreciate the risk in risk-free treasuries. When rates move the wrong way, losses can mount in a hurry. We talked yesterday to some of the biggest bond fund managers about how to manage the risk and what factors bond investors need to be watching. So PIMCO CIO Dan Iverson tells me his risk list starts with the idea that inflation is still a material risk. Debt levels are very high. Some investors are demanding default or downgrade premiums. The economy has been strong, and that could push up rates further. You guys were talking about just this stuff in the 6 a.m. hour. All that has been behind the recent sell-off, and he doesn't have tremendous confidence those risks have entirely played out. But Iverson is recommending investors look to extend somewhat the average duration in their bond portfolios. He's taken the duration of the PIMCO Income Fund with lots of billions of dollars in it up to 4.7 years, still low, but the highest it's been since 2014. All of that points up a risk that many sitting in cash and short-term bonds may not have thought about. Rollover risk. Those juicy money market yields, they can disappear like that if the Fed starts to cut, leaving investors with the risk of reinvest.
Okay, now I want you to listen to what he just said there. And what do you hear on the news? Higher for longer, higher for longer, higher for longer, higher for longer. And that's why the markets freak out and why the interest rates continue to go up. And yet he's saying the biggest risk to money market people is if the Fed decides to pivot and lower interest rates. Again, am I missing something here? I mean, the correlation, it's mind-boggling. I mean, in one section, they're telling you that, interest rates are not going to go down anytime soon. And now he's saying that the biggest risk to being in money markets and CDs and cash is the Fed pivoting. I'm here to tell you the Fed is not pivoting anytime soon. And especially if you're in cash or whatever, and the fact that you can't get out of it. Okay, if you have an advisor who's not smart enough to figure this out, get a new advisor. I'm sorry. But this really irks me that this kind of stuff's on the news because the inconsistencies are just, again, mind-boggling.
It may be lower yields and wishing they'd locked in the higher ones. I talked to John Croak, head of Vanguard's active fixed income products. He tells me a decision to be all cash or meaningfully overweight cash relative to your long-term allocation is a call that's relying on you and your advisor being able to reallocate towards your long-term equilibrium asset allocation.
And the key here is that it's actually managing money. It's not putting people's money into mutual funds and letting them sit there for 30 years and eventually things will work out. We're talking about actually being in touch with what's going on in the market and making adjustments. And we're not saying put all your money in cash. We're not saying put all your money into money. Again, and if he's thinking that, again, he's being stupid about this. There's nothing wrong with taking some money that you've made profit on, putting it in a money market for a little bit of time. Let the market kind of come back to you and buy back in. Whether that's buying back into bonds or stocks or money markets or mutual funds, doesn't really matter. There's nothing wrong with taking profit off the table, taking a breather and moving on.
In other words, staying short is market timing. It's a call on timing. Croak says better to make some of those choices right now while bonds are cheaper. Put a portion of the portfolio in what.
Yeah, because he's trying to get people to put money into the bonds so that it shores it up for him. Again, cash is an asset class, folks. It's okay to use it. Don't abuse it, but it's okay to put money into it.
They call the belly of the curves 3, 5s, and 7s. While there could be further losses, they're only losses if you sell. Croak says the big.
Okay, once again, only losses if you sell. It's the same thing with a stock. If you can stomach buying a stock and holding it and paying a 7-8% dividend, why are you doing any of the bond funds? This makes absolutely no sense to me.
Croak says the biggest risk is the behavior of investors who abandon their long-term strategy because of short-run fears, and they realize losses instead of riding them out.
Let me give you a better answer. What if you could take some losses, take the capital gain losses, write it off on your taxes, wait a month or two by putting the money in a money market and then buying back into some other stock that actually goes up for you and you get your money back? I don't even know what to say.
Thanks, Ed. If you had gone into a 10 or 15 or
Right then.
At 3.5, you'd already be looking at 80, probably at 70 cents on the dollar. So
You know what? That's the part I want you to get at. And the reason I've held off on bonds, the reason I've held off on a lot of this stuff is that you can be down, 25, 30% in bonds that do not come back quickly by putting money into a dropping market. Again, the old adage, trying to catch a falling knife. When the interest rates, when you don't know where they're going to stop going up, not really the time to be into it. Now, I'm not saying it's never the time, but when you've got volatility, it's much better off to make sure you're hitting the bottom. Now, my last part of this is that there are also some funds out there that have real estate in them, pay a decent yield, and I've had some questions about those. And again, I really think you need to wait till you see the bottom on those before you put money into it. Now, am I telling you to sell out of them? No. If you're already in them, take their yield, move on. I'm not saying they're bad investments, but I'm saying if you're trying to reallocate new money into positions, the whole statement of down and up, you don't buy on the way down, you wait for it to bottom, and you buy on the way up. Now, it could mean that you're buying at the same point as you did on the way down, but if you're buying here and it continues to go down, it creates a lot more volatility for your portfolio. Whereas if you wait for it to kind of settle and start to way back up and you buy on the way back up, again, you're never guaranteed on any of this stuff, but most of these things have normal patterns. So this is what's bothering me. It makes no sense to me that you have so much contradiction going on in the marketplace. And yes, the best thing is to stick to your long-term financial goals, but talk to your financial advisor. There are some strategies. There are some ways to maneuver through this portfolio or maneuver your portfolio through the market and make it make sense for your long-term objectives. Again, that doesn't mean you shouldn't make changes. It also doesn't mean that you should make changes. It means you need to be leery of what's going on and wary of what everything is happening in the marketplace and make strategic adjustments based upon your long-term goals and objectives. That's just my 2 cents worth. Talk to your financial advisor. Make sure that they are investing your money so that you can reach your long-term goals and objectives and you can retire when you want to retire and how you want to retire. Dickie out.